$32 billion evaporated in a matter of days, leaving over 1 million creditors staring at empty digital wallets and shattered financial futures. In the annals of modern financial deception, the catastrophic implosion of FTX in late 2022 stands as a dark monument to unchecked hubris. This was not a slow, predictable decay born of market forces. It was a spectacular, overnight vaporization of wealth engineered by a man hailed by the media and politicians as the prodigy of a new economic era. The sheer audacity of the missing funds sent a chilling realization across the globe. The money was simply gone. Sam Bankman-Fried presented himself as the absolute antithesis of traditional Wall Street greed. Clad in cargo shorts and oversized T-shirts, he captivated elite venture capitalists, seasoned lawmakers, and millions of retail investors with promises of effective altruism and radical financial transparency. He built an empire that seemingly legitimized the volatile, often shadowy cryptocurrency market. By projecting an aura of mathematical genius and moral superiority, he transformed a fringe, highly speculative technology into a mainstream financial juggernaut, disarming critics and bypassing skeptics. At its operational core, a crypto exchange is designed to function much like a traditional stock brokerage or a bank, holding customer deposits in secure custody in exchange for facilitating trades and earning transaction fees. Users trusted the platform to safeguard their digital assets, operating under the fundamental belief that their funds were sitting untouched in secure, segregated accounts. The platform boasted a sophisticated, lightning-fast trading engine and a user-friendly interface that actively masked the profound structural rot festering beneath its glossy, highly marketed exterior. Operating largely out of the Bahamas, the corporate entity aggressively exploited a massive global regulatory blind spot. Traditional financial institutions are bound by strict reserve requirements, mandatory capital cushions, and relentless independent audits, all designed to ensure they possess the actual liquidity to cover customer withdrawals at any given moment. Offshore digital asset platforms, however, existed in a nebulous jurisdictional gray area. This geographic and legal isolation allowed a charismatic founder to operate a multi-billion-dollar enterprise with zero meaningful oversight, no independent board of directors, and virtually non-existent internal risk controls. The fatal flaw of this digital empire was hardwired directly into the relationship between the main exchange and its sister company, Alameda Research. Alameda was conceived as a quantitative trading firm, essentially a high-risk hedge fund built to execute aggressive, high-frequency bets across the global crypto landscape. While the two entities were emphatically presented to the public, regulators, and investors as entirely separate and independent operations, forensic accounting would later reveal a deeply hidden reality. There was a secret digital backdoor explicitly coded into the exchange's software, connecting their financial nervous systems and bypassing all automated risk protocols. The trading firm, driven by the inner circle's unyielding belief in their own intellectual supremacy, possessed an insatiable appetite for speculative investments. They poured billions of dollars into obscure digital tokens, struggling cryptocurrency mining operations, and lavish, high-profile venture capital plays. When the broader market was experiencing a historic bull run, this hyper-aggressive strategy yielded massive, albeit largely theoretical, paper profits. But this relentless pursuit of absolute market dominance required a continuous massive influx of fresh capital to sustain its highly leveraged trading positions and mask its growing operational losses. To artificially fuel this massive expansion, the enterprise relied heavily on the creation and manipulation of its own proprietary cryptocurrency, known as the FTT token. The exchange essentially minted FTT out of thin air, assigned it a high market value based on tightly controlled public circulation, and retained the vast majority of the supply on its own balance sheet. Alameda Research then used these illiquid tokens as collateral, assets pledged to a lender to secure a loan, to borrow billions of actual dollars from external cryptocurrency lenders. It was a closed-loop system of synthetic wealth, a fragile financial perpetual motion machine entirely dependent on the market's continued, unquestioning belief in the token's inflated, artificial value. That collective belief violently shattered in the spring of 2022. A catastrophic, systemic crash wiped out several major digital assets, sending destructive shockwaves through the entire industry and triggering a brutal, unforgiving crypto winter. Lenders who had provided massive capital injections to Alameda began aggressively calling in their loans, demanding immediate repayment as the broader market hemorrhaged trillions in value and panic set in among institutional investors. Facing a fatal margin call that would have instantly bankrupted the trading firm, the inner circle needed liquid cash immediately. Rather than liquidate their highly illiquid venture investments, sell off their personal real estate, or admit financial defeat to the public, a catastrophic and illegal decision was executed. Through that hidden software backdoor, billions of dollars in actual customer funds, money explicitly deposited for safekeeping, were quietly siphoned from the main exchange. These funds were transferred directly to Alameda Research to secretly plug the gaping, multi-billion-dollar holes in its failing balance sheet. The grand illusion miraculously held for several more months until early November 2022, when a devastating piece of investigative journalism published a leaked, highly confidential balance sheet. The internal document laid bare a terrifying financial reality for the world to see. It revealed that the trading firm's assets were overwhelmingly composed of the exchange's artificially inflated FTT tokens rather than independent fiat currency, stable assets, or reliable outside investments. The financial foundation of the entire global empire was instantly exposed as a precarious house of cards built on self-generated digital paper. Panic remains the ultimate unforgiving stress test of any financial institution, traditional or digital. The explosive revelation triggered an immediate massive liquidity crunch, a terrifying scenario where an entity completely lacks the available cash or convertible assets necessary to meet its immediate, short-term debt obligations. Terrified users, realizing the platform might be insolvent, rushed to withdraw their digital assets simultaneously, demanding the return of over $5 billion in a single chaotic weekend. The digital vaults were completely empty. The money millions of users believed was safely stored and segregated on the platform had already been spent, gambled away on catastrophic trades, funneled into luxury Bahamian real estate portfolios, and dispersed as unprecedented political donations to buy influence. The horrific realization washed over the global financial community with a chilling, absolute finality. The supposed savior of digital finance, the media darling of the crypto revolution, had allegedly orchestrated one of the largest, most brazen financial frauds in American history. Within a matter of days, the once mighty corporate behemoth formally filed for Chapter 11 bankruptcy protection. The breathtaking swiftness of the collapse forced the immediate, disgraced resignation of its founder and the emergency installation of John Ray III, a veteran corporate restructuring expert famous for unwinding the complex wreckage of the Enron scandal decades prior. Upon examining the smoking corporate crater, the new leadership expressed profound public shock at the total unprecedented absence of trustworthy financial information, basic human resources records, or fundamental corporate controls. The grueling post-mortem investigation exposed a catastrophic, industry-wide failure of due diligence, the comprehensive, rigorous appraisal of a business undertaken by a prospective buyer or investor to establish its actual assets and liabilities. Some of the most prestigious, historically cautious venture capital firms in the world had blindly poured hundreds of millions of dollars into the company without ever demanding a seat on the board of directors, reviewing audited financial statements, or independently verifying the safety of customer deposits. They were completely blinded by the overwhelming fear of missing out on the profits of the next great technological gold rush. The financial contagion spread mercilessly and indiscriminately across the globe. Institutional lenders, competing digital exchanges, and massive asset funds that had significant intertwined exposure to the bankrupt entities suddenly found themselves dragged into the financial abyss. The sudden collapse wiped out an estimated $2 trillion in broader market value, instantly freezing crypto credit markets, destroying institutional faith in the decentralized finance ecosystem, and triggering a cascading series of secondary bankruptcies throughout the industry. Behind the staggering, abstract macroeconomic figures were millions of deeply personal, devastating individual tragedies. Retail investors from across the globe, ranging from seasoned traders to working-class families, lost their life savings, carefully planned college funds, and critical retirement accounts in the blink of an eye. Unlike traditional bank failures, which are strictly insured by government entities to protect consumers, these digital victims possessed absolutely no safety net. They were left to wait years in convoluted bankruptcy courts, desperately hoping to eventually recover mere pennies on the dollar. Federal prosecutors and international regulatory agencies moved with unprecedented aggressive speed, systematically unmasking the sheer audacity and scope of the criminal operation. Sweeping indictments detailed a sprawling, highly coordinated conspiracy of wire fraud, securities fraud, commodities fraud, and international money laundering. Forensic investigators meticulously tracked the stolen customer funds through a dizzying labyrinth of offshore shell companies, uncovering a calculated, cynical effort to buy immense political influence in Washington and silence potential industry critics through massive, strategic philanthropy. The subsequent, highly publicized criminal trial completely dismantled the carefully cultivated myth of the well-intentioned but overwhelmed, disorganized founder. Devastating testimony from former inner circle executives who had quickly turned state's evidence painted a grim picture of a deliberate, highly calculated scheme to misappropriate customer assets from the very beginning. The jury, presented with a mountain of irrefutable digital evidence and internal communications, delivered a swift and decisive guilty verdict on all counts, ensuring that the primary architect of the disaster would face decades behind bars. Yet, the severe incarceration of one man does not erase or resolve the deep systemic vulnerabilities that allowed such a massive fraud to flourish in plain sight. The disaster glaringly highlighted the highly dangerous, largely unregulated intersection of rapid technological innovation and age-old financial greed. It definitively proved that without rigorous, strictly enforced oversight and standardized transparency protocols, the digital financial frontier remains a remarkably fertile hunting ground for sophisticated predators and charismatic opportunists. The dark legacy of the 2022 collapse extends far beyond the immediate financial ruin of its victims or the collapse of a single corporate entity. It fundamentally and permanently altered the global trajectory of digital currency, forcing a harsh, unavoidable reckoning on the urgent need for robust regulatory frameworks and exposing the true, devastating cost of unchecked, opaque financial engineering. The name FTX will forever serve as a grim, historical warning to future generations. Whenever billions of dollars are shielded by technological complexity and cults of personality, the potential for catastrophic betrayal is never far behind.